Hi, hello, good evening, friends. Warm welcome, one and all, for the fourth session of Nifty Banker, India's first retail Bank Nifty Traders Conference. This is your host, 𝐿𝐨𝐬𝐢𝐬𝐢𝐬𝐿 𝐬𝐽. We have an interesting speaker today, Mr. Kushal Jain, who is the founder of 𝐿𝐺 and also Purple Trades. He has been in the financial markets close to 8 years now. He has been recognized by Zee Business. He has been a good player in the algo front. We have had multiple interactions. He builds strategies, he does automation on strategies, and me and Kushal, we have worked together on a couple of small projects as well. So Kushal, it's great to have you in this session today. On behalf of everyone, I extend my warm welcome into the system.
Thank you so much, everyone, and thank you so much, Ashok sir, for giving me this opportunity. Good evening, everyone, and I'm your host for the day, and I'll be with you for next 2 hours or so. Let's start the session without wasting much time. Let me directly take you to the slides. So, talking about Bank Nifty, I'll just tell you how the system works on Bank Nifty. Well, when I was trading in the market, I'm in this field from last 8.5 years, and I've tried several indicators. Usually, beginners try moving averages, MACD, RSI, then they go with advanced indicators, price action concepts, and a lot of things. Then finally, we find that no matter what system you deploy, it has certain limitations, it has certain accuracy, it won't perform every day, right? So the idea is to build a system that has an accuracy of greater than 50% and a risk reward system that is better than 1:1. This is a simple maths that we need to keep no, this is a simple maths that would make you profitable in the market, especially when you're trading. Any accuracy which is greater than 1:1 and any risk reward that is better than 1:1 will definitely make you a winner in the field of stock market. Now today what I'm going to teach you is a strategy that doesn't depend upon any indicator, that doesn't depend upon any price action or volume or anything. It is a simple observation from last 10 years or so. From our last 10 years observation, I have last 10 years data of Bank Nifty on my AMI broker, and based upon the observations of how indices usually move and what kind of pattern they make, based upon those observations, I have developed a very simple strategy. This strategy is very effective, and the advantage of this strategy is that it can be applied on index or options or futures or even equity. You can apply it on anything and everything, and you will still see that this strategy is profitable. I have last 10 years of data on AMI broker for all FNO stocks, Nifty 200 stocks, in equity, futures, and for index as well. And we have done various test cases of the strategy on multiple parameters, and in most of the parameters it has turned out to be profitable. Now when I talk about this strategy, I'll directly come to the point, because I assume that since you have already attended 3 sessions, you already know what is Bank Nifty. I need not explain you what is the lot size, how futures work, when is the expiry. I'll just skip everything, assuming that the audience size and the audience maturity at this webinar is very high and they're already trading in the market. So now what I feel is that the index, whenever indices have gap up or gap down, they're usually more volatile than the days they don't gap up or gap down. See, or there are days when indices do not gap up or gap down, yet they move 2.5% or sometimes 3%. But most of the days when they have a good gap up or gap down, they're usually more volatile than the days when they don't have a gap up or a gap down. So this is my first assumption, and I have backtested report also to show you how indices have moved when there is a gap up or gap down. But before I go to those indices, do you guys agree with this point, that index that opens gap up or gap down by a good margin is basically having more volatility than the index that doesn't have gap up or gap down? Do you guys agree to this? Yes, right? You're all with me, right? So, okay. Yes, so the definition of gap up, again, a very good question. So gap up can be even if there is a 0.01% difference, then also there can be a gap up, and if there is a difference of say 1, 2, 3% move, that is also called as gap up. So how do we define an ideal gap up? I'll come to that point. But before that, let me define, there are two ways a gap up or a gap down is defined. So the two ways of defining a gap up or a gap down is that, suppose say if today's open is greater than or less than previous day's close, it is usually called as gap up or gap down. This is one definition. The second absolute definition of gap up or gap down is that if today's open is greater than previous day's high, or if today's open is lower than previous day low, then those are called as absolute gap ups and gap downs, right? So there are two different ways. There are some conservative traders who consider gap up and gap down only and only if we are opening above or below yesterday's high and low respectively. But then there are aggressive traders when we consider that if from compared to previous close, if we have opened gap up or gap, that means if we have opened above or below previous day's close, we would still consider it as a gap up or gap down, right? There are two ways in which a gap up or a gap down is defined. Few books and few studies will teach you one way, the others will teach you the other way. Now for me, what is gap up or gap down? Basically, I consider yesterday's close itself as a reference point. So from yesterday's close, if today the open is well above or well below, I would consider it as gap up or gap down. Now for our strategy here, the gap up or gap down should be considerable. A 0.1% gap up or a 0.2% gap up or a 0.3% gap up or gap down is not enough. The gap up or gap down should be considerable. How much? It should be at least well and above 0.5%, right? So the gap up or gap down should be well above 0.5%. Only and only then we would say that okay, this stock or this is a trading day, on this particular day I'm going to take a trade. So it is usually observed that if indices are opening at a 0.5% gap up or gap down, they usually stay volatile on most of the sessions. And the advantage of this session is that, and advantage of this idea is that you won't have trade every day. In a month there might be only 4 to 5 days where you have such gap up or gap down setups, and in 4 to 5 days only one or two trading sessions at the max will be such that in spite of gap up or gap down, market is not volatile. But in majority of the cases you will see that if the market is opened 0.5% gap up or gap down, it is moving either one way or it is having a big correction in the other way because of profit booking, right? So this is the idea involved. So gap up usually means, gap up or gap down usually means two things. One is a trend continuation, second is profit booking. So we don't care whether the trend continues or because of profit booking there is a reversal. We just want the gap up or gap down. And the system that I want to teach you can be executed manually. Also it works very well when you deploy it on platforms like ME Broker or TradingView, and when you automate it. So I'll come to those points also step by step. But before going ahead, are you guys with me so far? Any questions?
Kushal, one quick question. In the slideshow, apart from the index, the top slide title, there's nothing. I hope it is the
There is
same.
nothing. I'm not yet started, sir. I'm not yet
Yes,
started.
perfect. People had some queries. That's fine. Go ahead, sir.
Right. Okay. Okay, so someone says if there is a pictorial representation, it would help. Yes, definitely we'll go there step by step. Screen is not displaying anything instead of yes, it is intentional that the screen is not displaying anything. Don't worry. Freehand drawing, yes, we'll do everything. Okay, so I've taken, I think, yes. So someone says nowadays Bank Nifty is gapping up every day. That means we are trading almost every day. We are basically trading almost every day. Right. So we are on the same page. Great. Let's move ahead. Shall we move ahead? A quick yes or no. Shall we move ahead? No doubts, right? Okay, let's move ahead. Let's move ahead.
Good, go ahead, go ahead.
Right, sir. So I usually want to have an affirmation from everyone. Right. So this is the last 10 years back-tested data that around 80% of the time when index opens gap up or gap down by 0.5% or more, it gives a move of 0.5% to 2% on an average. That means anytime that the index opens, like if 5 times any index has opened 0.5% gap up or gap down, there are very high chance that from that point onwards, either towards upside or towards downside, it will move in a range of 0.5% to 2%. We usually consider 1% as our target. Since the market is very volatile during these days, so we consider 1% as our target. But if the same strategy would have been applied, say 3 or 4 years from now, like in the year 2015-2016, then our target would have been only 0.5% from our entry. How is entry, how is exit, I'll tell you in a while. But what I'm trying to say is that we adjust our targets as per market dynamics. Today Nifty and Bank Nifty are moving as if they are some stocks. Some day it is 1% up, some day it is 2% up, some day it is 3% down, as if it is a stock. But back in around 2015 to 2018 period, when the Nifty and Bank Nifty were very stable, we hardly used to see a move of 0.5 to 0.7%, right? So as market dynamics changes, we should have this maturity to readjust our target. Okay, let's move ahead. So basically what happens is sometimes whenever there is a gap up or gap down, the gap continues, and usually sometimes the gap is filled. For those who are absolutely new and who do not understand price action, let me give you a very simple example. Suppose say you buy a stock at 100 rupees today for a long-term investment or for trading or whatever, for BTST, whatever may be the reason. You buy a stock at say 100 rupees. And today before closing, market has closed at say 104 rupees. It is already up by 4 rupees. Now next day morning, it has opened at 107 rupees. Already a big gap. So no matter how good a trader is, once he will feel ki acha, I'm already getting around 6-7% return and there is a huge gap up, let me try to book profit here. So this psychology is called as gap filling psychology. You might have read about this psychology in a lot of books, and this is called as gap filling or profit booking, because of which we see that whenever there's a huge gap, usually the market moves on the opposite direction as well. And sometimes that the sentiments are so high that in spite of gap up, the stock just keeps moving up because no one wants to sell and the demand has increased a lot. So irrespective of the reason, our whole agenda is to find the trending days in the index. The whole agenda of our strategy is to find on which day the market will be trending. And one filter that we have understood from last 10 years data is that whenever there is a gap up or gap down, a big gap up or gap down, those are generally our trending days. I'm least bothered about the trend. All I want is whether it is a trending day or not. I just don't want my market to be flat. I don't want the index to be flat. Rest, wherever it moves, I'm least bothered. I just want a move, right? Next, as I said, we are unbiased about the direction of index. We will try to catch the rally both ways. Here are some examples on AMI broker in last 2 months. So I'll show you whenever there was a gap up or a gap down in the index in the last 2 months or so, how it has behaved. In fact, if I go to trading view, I can show you the same data for last 1 year as well. The result would still be the same, but I'll just show you the latest data on my AMI broker. So I have 2 servers. On one I have 2 data, the other I have global data feed. So I'll just show you the same thing. So say I am starting from almost December, and this is an algorithm that automatically identifies whether there was a gap up or gap down above 0.5% or not. If the day we didn't have a gap up or a gap down above 0.5%, you won't